What if I told you the biggest risk in the stock market right now isn't panic, it's comfort? Because that's exactly where we are. No crash headlines, no emergency alerts, no chaos, just record highs and quiet risk building underneath. And that's when markets are the most dangerous. Last week, we saw something that should have caught more attention. Strong earnings reports, solid companies, and yet tech stocks rolled over. The market started drifting lower. That's how downturns often begin. Not with a bang, with a shrug. Your portfolio dips 3%, then 5%. Then one morning you wake up and 15% is gone. And suddenly everyone says, "Why didn't anyone warn us?" The warnings were there. You just have to know what to look for. Let's zoom out. When was the last time the market truly scared you? 2022? Maybe. COVID in 2020 for a couple of months? Before that? 2008? Here's the uncomfortable truth. Today, stocks are not just near all-time highs. By valuation, they are at levels we rarely see in history. People say unemployment is ticking up, or the economy feels soft. That's normal. The US economy moves in cycles. It always has. Long term, it grows. That's not what concerns me. Two bigger issues are stacking up. Problem one, we never got a real reset. From 2009 to 2020, we went over 11 years without a 20% drop in the S&P 500. That is rare. Speculation built up, risk piled on, excess grew. Then, COVID hit. The market dropped almost 40% in a month. But the Federal Reserve stepped in immediately. Rates went to zero. Trillions in liquidity. The pain was short-lived. Crisis avoided. But consequences? They never fully played out. The excess didn't disappear. It expanded. Problem two, valuations are stretched.
You've probably heard of the Buffett Indicator. It compares the total value of the stock market to the country's GDP. It's often referenced by Warren Buffett as a useful valuation tool.
Right now, by that measure, the market is around 125% above historical norms. For perspective, during the dot-com peak in March 2000, we were about 47% overvalued. Today, we are far beyond that. Another metric, the 1-0-year cyclically adjusted PE ratio, shows similar extremes. Historically, the S&P 500 trades around 15 to 16 times earnings. During the dot-com bubble, the CAPE ratio hit 44. Today, we are hovering around 40. That's not normal. Now, let me be clear. I am not predicting a crash tomorrow. Nobody can reliably do that. What I am saying is this. When you pay more for the same future cash flow, your expected return drops. That's math, not opinion. If I offer you $1 per year forever, and you pay $1 for it, that's a great deal. If you pay $10,000 for that same dollar, it's a terrible one. Same business, different price, different outcome. Let's look at history. During the tech bubble, companies like Cisco Systems were considered untouchable. Cisco hit $82 in 2000. It recently just reached new highs around $88. In that time, revenue and profit multiplied several times over, but the stock was flat for years. Why? Because investors paid too much at the peak. The business performed. The stock didn't. Price was disconnected from value. Right now, we are over 1,200 days into a bull market without a 20% correction. Long runs feel safe. But the longer they stretch, the more pressure builds underneath. Bubbles always start with something real. The internet was real. Real estate builds wealth. AI is powerful and transformative. But none of that answers the only question that matters. What are you paying for it? Even incredible companies like Tesla Incorporated can stumble. A few years ago, betting against Tesla seemed unthinkable. Now growth has slowed and competition is rising. Stories change. Valuation math does not. So what do you do if you're investing from Los Angeles or anywhere in America right now? You don't panic. You don't dump everything. You don't try to time the exact top. You manage expectations. You dollar-cost average into low-cost ETFs. You buy quality companies at reasonable prices. And when fear eventually returns, you lean in carefully. Because here's the truth most people ignore. Every past crash looks like an opportunity. Every future crash feels like a threat. But wealth is built by staying rational when others are emotional. The market in the short run is a voting machine. In the long run, it's a weighing machine. Right now, the voting is loud. AI, momentum, FOMO. Eventually, the weighing begins. Price is what you pay. Value is what you get. And today, Price is running far ahead of value. That doesn't mean sell everything. It means be disciplined, be selective, know what you own and why you own it. Because when the next real downturn arrives, and it will someday, the people who stayed calm and focused on valuation will be the ones buying while everyone else is selling. That's how long-term wealth is built in America. No hype, no predictions, just math, patience, and discipline. If this perspective makes sense to you, hit subscribe. Let's build a community that thinks independently and invests intelligently.